All right, guys. Hope you had a great weekend. And we're going to start right off with Nvda, who reports earnings on a Wednesday after market close. So they announced last week they're doing a 4-to-1 stock split, and that should cause the price to rally a bit further. But keep in mind now that we've already had a push up from 550 up to 602 or so in the last couple of days. It's likely that earnings are priced in. So I would be cautious in trading Nvda prior to the report. The actual way that I would trade it would be to trade AMD, which had some great news last week in that they announced a $4 billion buyback, which is their first buyback since the 90s, I believe. And that's a pretty big buyback for a company that's worth about $90 billion, right? So it's about 5% of their floating shares. And if Nvidia has a good report, it's probable that we're going to see AMD move up along with it. And looking at the chart here, we've seen over the past 10 months or so, whenever it hits the 75 range, consolidates there for a little bit before moving back up to around 85, 90 bucks again, right? We've seen that happen numerous times. So we had a big sell-off from last earnings report down to a low of about minus 20% roughly on the pullback after earnings, even though it was a phenomenal report. And now with this catalyst of the $4 billion buyback here, I think we have an easy road to around 85 again over the next month or so. So I mentioned some plays last week, the 75, 85 call spreads for July. Obviously that's more time, a bit more premium, but the whole idea is that you have more time to be correct in your thesis in the event that the market has a pullback. Right now, as I speak, futures are relatively flat. Like NASDAQ is actually flat. It's 0% right now. S&P or ES futures right now are up 0.2%, and the Russell's up 0.24%. So very, very flat overall. US dollar index still taking a dirt nap right now, trading at multi-year lows. That's not good overall for the US dollar, obviously, but it's decent for the US market because there's an inverse correlation between USD value and market performance typically. So the lower the USD goes, the higher the market goes usually, right? And vice versa, obviously, if the market pulls back or if the US dollar rallies, then it usually causes a pullback in the market as well, right? Because it makes it more expensive for foreigners to invest in the US market, that's why. So looking at Nvidia again, or sorry, AMD again, I think that playing the call spreads is a good idea, or legging into them if you want as well, buying some time. You can just see how much happens in the space of a month or even 2 months, right? So like over 2 months, for example, looking at 2 month segments. So that'd be pretty much this window right here, or this window right here, or over here, or over here. You can see that it has the ability to move pretty dramatically in short periods of time. So, we've seen it move from 74 up to 95 down to 74 in the span of less than 2 months, right? We've seen it go from 74 to 85 numerous times, back down again, back up again. So this is probably part of the same trend. This consolidation has been occurring for about 10 months now or so, and this just creates a very, very strong support level right around the 73 to 75 area. So again, phenomenal company. They've been crushing earnings. They're doing a nice buyback. I think that they're going to hit $100 by the end of the year. If you want to play it longer term, obviously you can go with in the money contracts, call options, leaps, right? You can buy shares if you want as well. Those are nice to trade just because they don't have any IV attached to them, so you're paying no premium. But capital efficiency wise, you want to go with leaps probably in the money. So again, I'll just pull up some options here to look at for AMD, and let me pull that up. Here's the option chain. So if you're to go long term, let's say you want to go to January on the thesis that it goes to $100, for example, right? Well, you can play it any number of ways. You can buy call spreads out of the money, but keep in mind when you're buying call spreads this far out, even if it goes in the money, you won't be anywhere near maximum profit. So that's kind of the issue with using call spreads this far out. You can use calendar spreads where you buy, for example, a call option that expires in January, and you sell against it a shorter term call option out of the money above your break-even price on a shorter duration, right? That requires you to usually buy in the money contracts in order to do that effectively, right? So for example, you might look at January $70 call options, you buy them for about $13.50 right over here, right? That would mean a break-even price of $83.50, in which case you need to be selling contracts on the shorter durations above $83.50. So for example, for June OPEX, you could sell the 85 call options for about 70 cents, right? That would shave off your overall exposure on your position. So 0.7 divided by 13.5, that's a return of 5.2%, plus you get upside of $1.50 as well on the position over the next month or so, right? Next 4 weeks or so, right? So that's one way of trading it. And again, you're controlling effectively by buying January contracts, you're controlling roughly 70 shares for one call option over here, right? The reason being is the delta is 0.68, which means that you're pretty much controlling, I guess, 68 shares, if you will. But your break even is 83.50 or so, right? So if it goes to $100 by end of the year, your contract is worth $30 and perhaps a little bit more due to extrinsic premium, but not much more than that, right? So that could be a nice double up. Whereas if you were to buy the stock right now and it goes to $100, you're making a return of about 27%, right? Versus over 100%, right? And likewise, if the market were to pull back hard, your maximum exposure is $13.50 versus, you know, if you bought 100 shares at the current price, it'd be $7,700 or so, right? So again, Nvda reports Wednesday after hours, and I would trade AMD instead of trading Nvda, because if Nvda beats and issues good guidance, you're probably going to see SMH, which is the semiconductor ETF, rally, which will pull AMD up with it as well, right? Not to mention the AMD buyback, which is a big catalyst to the upside. Next up, we have Salesforce as well, right? So I'm going to look at Salesforce, which is over here. CRM. They report Thursday after close. As you can see, they've been kind of in this little downward trend over the last few months, right? Roughly over here, this little narrow channel or so. And they have some gaps. Actually, wait, gaps are filled over here. But yeah, current price 23 or so. So the price is pretty good overall, considering that they were at 250 a few months ago and actually up to 270 prior to that. I would look at perhaps some call spreads if you're trading shorter term contracts. But again, I like it longer term. Given what we've seen with Apple, AMD, Netflix, Microsoft, a lot of these bigger companies that performed very well on earnings, they ended up falling after the report. So I may just wait until after the report itself. It would be nice to see a good report followed by a stock price decline to around like 210 again. That would be a nice entry point. Again, the IV might be elevated right now, but let me just pull up the option chain to confirm that. So right now, yeah, the implied volatility is much, much higher than normal. So I can see that the IV right now is 33%. The historical is 23%. So you're paying about a 10% premium over the historical average, right? That means you're paying roughly 50% more than what it normally goes for on options right now. And after the report, if they stay flat, you get IV crushed. So again, I would wait till after the report and then play some options longer term, perhaps a few months out with a target price of around 250, 270. And that would probably be a good way to play it. They report Thursday after close, right? Alternatively, this week, so we have here's some more reports we have right here, so you can see. Tomorrow we have not very much reporting. Tuesday we have Intuit, Zscaler, Nordstrom. That's basically it. Wednesday we have Dick's Sporting Goods, Nvda. We have Okta, Workday, Nutanix as well, NTNX. And then Thursday, you have Best Buy prior to market open, Dollar General, Dollar Tree. And then you have Box after hours, Autodesk after hours, HP, Ulta Beauty, Gap, and Costco. So a lot of retail reporting this week. Keep an eye on the XRT ETF because they cover retail as well. That's retail ETF. But the big names are Salesforce and Nvda, right? Now, going back to the option chain, let's look at SPY because SPY has been pretty volatile the last few weeks. We still have yet to fill that gap at 400. but I want to analyze the expected moves for a month out. So looking at the January 18th OPEX right now, expected move on SPY is about 15 bucks in either direction. So upside is 430, downside is 400. A lot of people are asking me questions about how to hedge their portfolios. The thing is that if you're holding stock or options on certain names that have higher volatility, hedging with SPY isn't going to really be a true hedge, right? Take, for example, the recent decline in growth stocks, right? A lot of those lost 50% or more. Meanwhile, the market is still not too far from all-time highs, right? So it all depends on what you're holding in your portfolio as to how you hedge, right? If you're holding, Apple, Microsoft, those kind of names, like the bigger companies that are part of the S&P and the Nasdaq, then yes, it makes sense to hedge using those vehicles, right? But if you're holding, growth companies that don't comprise too large a portion of these ETFs, then hedging with them doesn't make any sense at all, right? I would lighten your position if you're concerned about a decline causing you a loss, right? And obviously, buy more time. Don't buy short-term contracts. Trading short-term is much more binary. I trade short-term on occasion as well, just because it's fun for me and I enjoy it. But I know that it's much more binary in nature, and I don't risk more than I can afford to lose, right? So going out a month or more, it makes a lot more sense. Ideally, 60 days or more, because remember that time decay kicks in the hardest in the last month or so until expiration, right? There's also someone asked me about Visa, so I'm going to pull up that as well. They are not too far from all-time highs right now. Here's the chart. So we've had a pretty nice steady uptrend over the past year. Nothing to write home about overall. It's up about roughly 10% or so this year, but we're nowhere near the all-time high of 235. So right now, we may be seeing an upward push to that level. And again, right now, the IV is 21%, HV is 18%. So overall, IV is a little bit higher than usual. I would look at buying options a few months out if you're going to trade that to the upside. One other company that I was looking at is OTLY. The IPO last week. It's Oatly. This is a vegetarian beverage company, a milk alternative, if you will. They make oat milk and oat yogurt and like an oat butter and oat ice cream as well. They're from Sweden, and Starbucks actually uses their beverage at most of their locations. So they've seen a lot of growth. They're worth about 10 billion right now, doing about 400 million in revenues. So they're a bit rich overall for my liking, but I'm looking at them and hoping that they pull back to around 15-ish, because I do like the company and think that they have a future that is pretty bright overall, because I've tried their products and they're great products, right? Like phenomenal taste. It tastes better than milk, I would say. So if you haven't tried it yourself, I would try it out, but keep an eye on OTLY. Again, I would enter around 15 bucks or so below the IPO price, because obviously right now it's a bit inflated, and it might get more inflated. It might go to 30 or 40 bucks perhaps before it comes back down, kind of like Beyond Meat. Look at Beyond Meat's chart, similar kind of idea. But look at what happened with Beyond Meat when they IPO'd, right? So they shot up from an opening price of 45 all the way up to 240 or so before coming back down. Now they're at 106, right? So again, you want to be patient for your entry. Granted that, Oatly's trading at 22 bucks a share or so, that doesn't really matter because the market cap is much higher because they have more shares outstanding, right? So you want to look at it around 15, maybe even like, $13 or so on a pullback. I'm just going to keep it on my watch list and monitor it for the next few months. If it pulls back at some point, I might buy a few hundred shares and just keep them in my portfolio longer term. Otherwise, looking at the Qs, right? We are still off the all-time highs, which are at 340 or so. So I think that money's going to rotate back into tech again as the reopening plays kind of scale down a little bit, airlines and cruise lines and whatnot. I think we're going to see a lot of money pull back into tech, namely Apple, Microsoft, AMD. Those are the big ones I'm looking at right now. There's also Alibaba too, which has been beat up pretty unfairly for the past few months, and it's trading near your lows right now too. But yeah, for Qs, I'm gonna go ahead and say that we're probably going to see a new high before we decline back down again. There is, however, a gap right over here at around 274 that I'd expect to fill probably by next year at some point. But again, don't bank on that happening over the course of a month, for example. Like, don't be buying put options short term to try and catch that move, right? It's impossible to time. So we're seeing curl back up right here. And as you see, if I zoom in on the chart, on the 1 year, whenever we see a recovery, it happens very, very fast, right? We fell back from February 16th, we were at 338 or so, down in a few weeks to 297, and within a month we were back at 341, right? So when they get going, the big tech, they get going pretty fast, right? And here's looking at Aapl, just for reference. They're nowhere near all-time highs yet. All-time highs are 145.09, and right now we're at 125.31. So expect a move up to 135 or so in the next, I would say, roughly month. And by July OPEX, I would say 140 is a decent target, assuming we don't see a broad market pullback. But again, I think tech is going to be leading the way over the next few months. Microsoft also performing pretty well, but they are also off all-time highs after earnings. And again, you see there's a gap right there on the chart at 261.97. Look at what happened last ER, right? Almost the exact same move, right? Big run up prior to earnings, right? Earnings reported, falls back down, consolidates for about a month, then pops back up into the next report, right? So right now we're seeing some consolidation phase. It may last another couple of weeks or so, but then I expect to move up to all-time highs and above prior to the next report, which should take place in late July, early August, right? Otherwise, there's Riot and Mara, which again, over the weekend, if you're following crypto, Bitcoin, Ethereum, everything's getting destroyed this weekend, right? There's a massive sell-off. That's actually forced liquidation. So if you understand the mechanics of markets, when actions are forced, they have magnified consequences, right? So by that I mean, when someone's forced to liquidate a position, that usually precipitates a massive amount of selling, right? Whereas buying is rarely ever forced. Granted, in the case of GameStop, for example, we saw forced buying there, which caused a massive rally in that stock price. But with cryptocurrencies, there's a lot of leverage in there, right? In the case of buying, a lot of people are using leverage to buy. So when it sells off, they get forced liquidated and margin called, and that causes an exacerbated move to the downside, right? It can last a lot longer than expected, and be much sharper than expected as well. So if you are trading cryptos, be very careful. Don't get caught up in the hype of it, because a lot of people in the last few months have totally bought in. They've opened up new accounts, tossed a bunch of money into these meme coins, and some people will make money inevitably, but a lot of people, the majority of people, just like with wheat stocks a few years ago, will lose money, right? So be aware of that. Yeah, back to Riot and Mara. So Riot, again, tomorrow it'll probably sell off down to around 18 or so, perhaps. I wouldn't buy these stocks just because, again, I don't think they're good quality companies. But if you're trading them, be cautious. Maybe if you want to enter in at a lower price, use cash secured puts, because IV is very, very high. So, for example, let's look at the option chain on Riot, right? So Riot's right over here. You can see that just a month out right now, even at the $15 strike price, you're getting about 80 cents of premium, right? That means that you're taking in 80 cents on risk of 14.20. So your return there is about 5.6% in 4 weeks. Not too bad at all, assuming that you don't mind owning Riot at $14.20 per share, right? Keep that in mind. So I would say cash secured puts are a great strategy to use, as long as you don't mind owning the asset, right? And a lot of people, as Ashish says, they always say, I don't mind owning it at a certain price, and then it falls down to that price and they no longer want to own it. So you gotta be sure that you actually do want to own it. Don't go out on a big position and like leverage yourself to a point where if you're assigned, you're gonna have too much of a certain stock in your portfolio, right? You don't want that. So again, using CSPs to enter into Riot and Mara might not be a bad idea. I don't want to own them myself, but again, to each their own. If you want to own them, that's your choice. Do your own research, do your own DD, manage your own risk, right? And also on that note as well, when you're managing risk around option portfolios, you want to be buying smaller positions depending on your time frames, right? So for example, if you're trading, a month or less, you should be allocating no more than like 1% to your trade, to a given trade for a given stock. for direction, right? So if I'm trading Aapl, for example, over the course of a month, let's say I buy June contracts, call options, you shouldn't be putting more than 1% of your portfolio in that position. However, if you're trading, for example, on leaps 1 year out, it's fine to buy more contracts because it's more of an investment, not a trade, right? You're trying to essentially mimic the movement in the stock through options using less capital, right? So less risk on short-term positions, more risk if you want on longer-term positions. That's the rule of thumb you should take. But again, no more than 1% on short-term positions. And if you're trading, 0 days or same expiration, be prepared to lose whatever you put in, right? Don't take a trade, lose, and then complain about it, right? That's your choice, okay? But be very cautious, okay? Because capital is easy. It's easy come, easy go typically, right? If you make capital very fast, the same way that you made the capital, it can disappear. So, buying meme coins, buying penny stocks, buying out of the money call options in a bull market, easy money. But using the same strategy over and over again, when the market's flat or pulls back, that costs you a lot of money. And if you don't manage your risk well, you can go from, in the case of someone that I know, from $4,000 to $70,000 to zero very fast, right? So hopefully that helps you guys with your plan for the week. If you have any questions, I'll drop them below. I'm going to stop the recording now and do some Q&A. But thanks for watching, guys, and have a great week, okay?